Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Inflation has surged in the March quarter, putting a whole lot of pressure on the Reserve Bank ahead of its monthly board meeting next week. Headline inflation came in yesterday at 5.1%, its highest annual rate in more than 2 decades. And underlying inflation, the RBA's preferred measure, rose to 3.7%. Well beyond the central bank's target of 2 to 3%. AMP senior economist Mousina is my guest this morning. You can also catch Deanna moderating a panel today and tomorrow, in fact, at the Accounting Business Expo in Sydney. Fear and Greed is a partner of the Expo. Deanna, welcome back to Fear and Greed.
Thank you so much for having me.
So, what do you make of the inflation figures yesterday? Higher than you thought or not?
It was an upside surprise. I mean, we had already been looking for a pretty elevated quarterly inflation print. We were expecting actually the same as consensus, so 1.7% for the headline over the quarter and 1.2% over the quarter, and the data was stronger on both measures. And the focus is really on the trimmed mean, which is the RBA's measure or preferred measure of core inflation, which is running at 1.4% over the quarter and 3.7% over the year. And of course, if you annualize that number, you get a much stronger outcome, close to 6%. So the concern here is that while there are a lot of temporary factors that are working to push inflation higher, there is no sense of how long these temporary factors will be around for. I mean, some of these supply chain pressures could still be pushing inflation higher in the next 6 to 12 months. The flood impacts and the impacts on supply from the flood could still mean higher fresh food prices for a number of months. And this is a negative for consumers. It decreases consumer purchasing power and for businesses as well. So the RBA needs to get on top of these high inflation prints.
Okay, so just what were some of the reasons for it? You mentioned the floods pushing up food prices, I think beef prices, but there are also other things like obviously fuel, which is not part of the underlying measure, but dwelling as well. What else was there?
There's a few things going on. There's a lot of global supply side disruptions, which we've spoken about before. That's related to high goods demand from consumers, transport issues causing higher transport costs and storage costs, higher commodity prices, which started before Russia-Ukraine war broke out. The prices for food, for example, was already at a multi-year high, but the war has exacerbated some of these commodity price impacts. So commodity prices are rising. Commodity prices are obviously an input factor to many different parts of the supply chain process, and especially in food. And that's leading to higher prices across the board as well. So just some notable increases in the quarterly inflation data: higher prices for fuel, petrol up by 11%, higher prices for food up by about 2.8%, household gas and fuels up by 6.3% over the quarter. There were also some temporary increases in prices for things related to medical prices or pharmaceutical goods. That's related to changes in the pharmaceutical benefit scheme, which is a cyclical thing, and tertiary education, which is related to some government changes around pricing for education. I don't think that those factors will continue into the coming quarters. And also, as you mentioned, higher prices for that category called dwelling purchases by owner-occupiers, which is ultimately a guide to cost of housing construction. And recently that category has been quite low because the government was handing out the building grant. And now that that's ceased and we've seen some prices for materials for housing increase, that category is rising quite fast. But broadly, there's been a very broad rise in consumer price baskets. We're now seeing that about 56% of total CPI baskets have annual inflation above 3%. Just last quarter, it was 35%.
Wow. Okay. So for many, many months, you've been forecasting a rate rise about now, or in the next couple of months at least, and the consensus has come to you on that. You seem to be proven right. What chance that the Reserve Bank will lift rates in a week's time?
Well, we think that we will get a rate rise next week now, and we think the rate rise will be 40 basis points. So that the cash rate will move from 0.1 to 0.5% next week when the RBA meets before the election, and that will get another rate rise in June, and that the cash rate will end the year at 1.5%. That sounds quite aggressive compared to the median or the consensus economist estimate, but it's not that aggressive compared to market pricing, which is, markets have been pricing in a cash rate at around 2.5% in Australia for about a month or 2 months now. But we think that the RBA will want to get on top of the high inflation numbers. I think there is some genuine reasons to believe that the Fed probably has made a policy mistake by not hiking rates sooner, or by hiking rates by more earlier in the year, and now they'll probably need to do a few 50 basis point increases. I think the RBA would ultimately like to avoid having to raise interest rates by 50 basis points at a time. I don't think that the Australian consumer would be able to withstand a few 50 basis point rate hikes as much as they could in the US.
Stay with me, Diana. We'll be back in a minute. My guest this morning is AMP senior economist Diana Mousina. Do you think the fact that the quarterly inflation rate, if you times it by 4 to get an annualised inflation rate, is just that much higher than the annual rate, which suggests that price rises are increasing speed in a sense? Do you think the bank will suddenly realise that the whole mantra of keeping wages growth between 2 and 3% sustainably, and also prices between 2 and 3% sustainably, was wrong?
Well, they've had this inflation target for many decades now. And so if we're questioning that, then I think we need to question, well, does the inflation target of 2 to 3% make sense? And is it sustainable? And I think ultimately, yes, it is. I don't think that we should be changing the inflation target or the wages target. But we've had now 8 years of inflation being below the RBA's target band. So if we have a few years where it's above the target band, then I don't think that it is a big problem. The problem arises when you have inflation that's out of control, rising at 4% or more per annum. I think that that is not a good outcome, and that's what the RBA would want to avoid, and that's why they should start hiking rates sooner rather than later, to avoid going down the path where inflation becomes unsustainable.
I mean, you wrote a note yesterday which said a stitch in time saves 9, which is kind of what you're talking about here. The Reserve Bank does need to jump on it right now and not wait till June or later in the year. Is that right?
Ultimately, and we also think if they don't raise rates next week, knowing that we have this global backdrop of high inflation occurring in all of our major counterparts, the US, UK, Canada, New Zealand, Australia has lagged some of this pickup in global inflation, but our circumstances in the global picture aren't that different. We might have some domestic differences in how things are priced, how wages are priced, which has allowed us to not have these high inflation prints. But we ultimately can't escape the very high global price increases that we've seen recently, and Australia won't be able to escape that. And if they don't go next week, it raises questions about how involved they are in the political process, and they wouldn't want to do that, especially at a time when they're going to be under review, I think. Even though we have an election later in May, I don't think it should prevent them from making the right decision for the economy.
Yeah, I mean, the point is if it decides for electoral reasons not to lift rates when the economic reasons say it should, that's as political as not lifting rates.
Yes, that's right. And then you run the risk of later down the track heading into a situation where inflation could get to over 6% like it is in the US, and that will be a big problem.
Okay, what about the impact on the Aussie dollar, equities, bonds, investing generally? What's it mean if we hit a rate cycle? The rate cycle starts next week and continues through to 1.5% cash rate by the end of the year.
It's a messy story at the moment. The market pricing is quite aggressive, as I said before. So the market's priced in a cash rate of about 2.5% by the end of this year. So even when we start to see rate rises come through, I don't necessarily see it as being a huge negative for the equity market, because the equity market should already be reflecting what the market pricing is. So in the short term, you might see some disruption to share some downside. I mean, we're already experiencing a bear market, or a soft bear market, if you want to call it that, more so in global shares, not as much so for Australia, because we've been supported by high commodity prices. But we may see some short-term negatives for the share market, but I still think on a 6 to 12-month view, there's still enough positives for share markets to have a low but positive return. We haven't seen the peak yet in earnings. Earnings growth and expectations is still positive in Australia and globally. That should drive share markets higher. The economy fundamentally is still in a solid position, but inflation is getting to the point where it can start to get out of control. And until you start to see households fundamentally change their behavior from rate rises, which I think they will obviously do at some stage once you get too many rate hikes, the economy can still perform pretty well. So I think in that environment, share markets can still do okay. And bond yields, in the same vein as share markets, the bond market's already priced in all these rate hikes. May see some short-term increases in bond yields, but in the longer end of the curve, I think it's difficult to see a substantial lift further unless the market starts pricing in even more rate hikes for a year or 2 years' time.
Now, Deanna, you are a busy person. You're hosting panels at the Accounting Business Expo in Sydney today and tomorrow. The Accounting Business Expo is a partner of Fear and Greed. What are you going to be talking about?
Oh, well, I think the focus will have to be on inflation after the data this week. But the overall story is around how Australia is placed over the next few years, what will be the growth drivers. We've obviously seen this big rebound in Australian growth after the pandemic. We've done very well. But what does the future look like? What will drive economic growth at a time when interest rates are getting hiked and fiscal policy is becoming a bit tighter? And what does that mean ultimately for industries like accounting and finance?
I look forward to it, Deanna. I will be there. Thank you for talking to Fear and Greed.
Thank you so much.
That was AMP Senior Economist Deanna Mousina. Catch her at the Accounting Business Expo in Sydney today and tomorrow. It's free entry and it's at the International Convention Centre. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.